Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Key Financial Ratios Demystified for Smart Investors. A practical guide to ratio analysis, understanding financial metrics for smarter decisions. Understanding a company's financial health can feel overwhelming without the right tools. Ratio analysis simplifies this process by breaking down complex financial data into clear, actionable insights. It helps business owners, investors, and analysts evaluate performance, identify trends, and make smarter decisions. Whether you're comparing profitability, liquidity, or risk, ratio analysis is a key step in understanding where a business stands and where it might be headed. What is ratio analysis? Ratio analysis is a way to measure and understand a company's financial performance by examining its financial statements. By comparing key figures like revenues, expenses, assets, and liabilities, it provides insights into profitability, efficiency, liquidity, and solvency. Simply put, it's like a health checkup for a business's finances. Whether you're an investor, a manager, or a creditor, ratio analysis helps you make informed decisions with hard numbers backing them up. Historical context of ratio analysis. The concept of ratio analysis has been around for more than a century, serving as a foundation in financial assessment. It started becoming a formal tool in the early 20th century when financial statements became more standardized due to the rise of industrial capitalism. Businesses needed clear and consistent ways to compare performance across industries and time periods. Before computerized systems, analysts calculated ratios manually, using ledgers and balance sheets. Though the math was straightforward, it required meticulous attention to detail. Over time, the practice evolved with advancements in accounting practices and regulatory frameworks. Today, ratio analysis is essential for financial reporting, allowing firms to comply with industry standards and provide transparency to stakeholders. Despite the modern tools available, the principles behind ratio analysis remain the same, comparing relationships between numbers to gain deeper insights. Importance of ratio analysis. Why is ratio analysis such a big deal? Because it makes decision-making easier. Think of it as a GPS for navigating a company's financial data. It shows you where the strengths and weaknesses are. For investors, ratios can reveal if a company is growing efficiently or struggling to turn a profit. For creditors, they assess whether a business can repay debt. For management, ratios highlight areas needing improvement, such as cost control or resource allocation. Here's how different groups use ratio analysis. Investors, they rely on ratios like return on equity, ROE, and earnings per share, EPS, to gauge profitability. These metrics help them decide if buying stock is a good idea. Creditors, lenders focus on liquidity and solvency ratios, like the current ratio or debt-to-equity ratio, to judge a company's ability to meet its financial obligations. Managers, internal teams track operating margins, asset turnover, and efficiency ratios to improve day-to-day operations and long-term planning. In short, ratio analysis acts as a universal translator for financial data, making abstract numbers clear and actionable. Whether you're building a budget or deciding whether to invest, these ratios give you the answers you need. Types of financial ratios. Understanding financial ratios is like having a multi-tool for analyzing a company's strength. Each type of ratio serves a specific purpose, helping you get a clear picture of where the business stands. Let's explore the main categories of financial ratios and what they reveal. Liquidity ratios. Liquidity ratios show whether a company can cover its short-term obligations. Think of this as a business's ability to pay the bills. Two key ratios fall under this category. Current ratio. This is calculated by dividing current assets by current liabilities. A ratio above 1 suggests a company can meet its short-term bills, while a lower ratio might hint at cash flow struggles. Quick ratio. Also called the acid test ratio, this measures short-term liquidity without relying on inventory. It's calculated by subtracting inventory from current assets and then dividing by current liabilities. This is especially useful for industries where inventory might not sell quickly. Liquidity ratios are critical for bankers and creditors who need assurance that the business isn't overextending itself financially. Profitability ratios. Profitability ratios focus on how well a company turns income into profit. They answer a simple question: is the business making money efficiently? Net profit margin. This ratio shows how much of each dollar in revenue becomes profit. A higher margin means better cost control and profitability. Return on assets, ROA. It measures how effectively the company uses its assets to generate profits. Higher ROA equals more efficient use of resources. Return on equity, ROE. This shows how well the company uses shareholders' investments to generate returns. Investors closely watch this ratio for signs of strong management and profitability growth. These ratios are the go-to for investors and managers looking to assess bottom-line performance. Leverage ratios. Leverage ratios, also known as solvency ratios, evaluate how much debt a company uses to fuel its growth. Too much debt can spell trouble, but a healthy balance can boost returns. Debt to equity ratio. This compares total debt to shareholders' equity. A high ratio means the company relies heavily on borrowed money, which could be risky. A low ratio can indicate a conservative approach to financing. Interest coverage ratio. This tests the company's ability to pay interest on its debt. It's calculated by dividing earnings before interest and taxes, EBIT, by interest expenses. A higher ratio means the company has plenty of earnings to cover its interest payments. Leverage ratios are a vital signal for lenders and investors assessing long-term financial stability. Efficiency ratios. Efficiency ratios show how well a business uses its assets to generate revenue. These ratios shine a light on operational effectiveness. Inventory turnover. This tracks how often a company sells and replaces its inventory during a period. High turnover suggests efficient inventory management, while low turnover can indicate overstocking or weaker sales. Asset turnover ratio. This measures how efficiently the business uses its total assets to generate revenue. A higher ratio reflects better performance, signaling that the company knows how to squeeze value from every dollar of assets. Efficiency ratios matter for operations teams and managers aiming to streamline processes and cut waste. Market ratios. Market ratios give insight into how a company's stock is valued in the market. These ratios are key for investors deciding whether a stock is worth buying. Price to earnings, P/E, ratio. This compares the company's stock price to its earnings per share. It tells you how much investors are willing to pay for each dollar of earnings. A high P/E ratio might signal growth potential, while a low ratio could mean undervaluation or risk. Dividend yield. This calculates the annual dividend payout as a percentage of the stock price. Investors seeking steady income keep a close eye on this ratio as it highlights dividend-paying potential. Market ratios help bridge the gap between company performance and stock market expectations. How to perform ratio analysis. Performing ratio analysis requires a mix of methodical steps and attention to detail, but it doesn't need to be overwhelming. It's about combining the right numbers with clear reasoning to draw useful insights. Whether you're evaluating your business or someone else's, the process boils down to gathering data, running calculations, and making sense of the results. Let's break it down step by step. Gather financial data. The first step is to get your hands on the right financial documents. Without accurate data, your analysis won't hold up. Here's where to look. Income statement. Also called the profit and loss statement, this shows revenue, expenses, and profits over a specific period. Balance sheet. A snapshot of the company's assets, liabilities, and equity at a point in time. Cash flow statement. This outlines cash inflows and outflows, giving insight into liquidity and operational health. Most companies make these documents available through annual reports, regulatory filings, like Form 10-K in the United States, or investor relations websites. For small businesses, check internal accounting software or consult with your bookkeeper. Make sure the data is up to date and reliable. Mistakes on the source documents can skew the entire analysis. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.